Welcome to the Traders Clinic, your regular shot in the arm of trader insights, philosophy and knowledge, brought to you by two professional money managers, Crooks and Charlie Burton.
In each episode, we answer your burning trading questions and cover all things in the world of trading.
We do indeed. And
See you, mate.
You too, new studio and all of that?
Yes.
I know, we said we wouldn't mention it, but oh well.
We're here. It's good.
Okay. What have we got this first?
So we're kicking off with, I think this is a really great question that's come in, which is, why do financial journalists get it so wrong?
Yeah, why do they? Do you want to go?
Well, yeah, I think I'll start with a broad perspective. I think the first thing to remember is the clues in the question is they're financial journalists. It doesn't necessarily mean they're traders. It doesn't even mean they're analysts. So the primary objective of an article is to inform, but it's also to entertain. And these days, with so many information sources, there's an element of potential clickbait in the title. So it could be that the title is worded a certain way to get you in. So there's that to bear in mind. But also, I think it comes back to what I said originally, which is, the clues in the name. They're financial journalists. It's not their job, and there's no money on the line necessarily if they get it wrong or get it right.
Well, they're not traders. So they are human beings who just report on. It just so happens that they are journalists who report on financial news. You have journalists who report on sports, and when you go to journalism school, university, you do journalism, and then you might then branch off into whether it's sport, economics, whatever. So they're not traders, and so because of that, they're going to get excited when the markets are going up. As humans, that there's going to be a point where they're going to be like, I really need to write an article because the Dow's just hit 50,000. This is amazing, sort of thing. Whereas a trader might be thinking, oh no, it's getting really, from a sentiment perspective, everything's getting really euphoric out there. And so a journalist gets euphoric, gets excited that, it's the Dow at 50,000. Or it's the opposite is true, and we're in a bear market, and there's a point whereby they're naturally going to start writing articles about the end of the world or whatever. And it's at that point, as to start off with, or take us back to that question, it's at that point that we need to start looking in the opposite direction. Coming back to, why do they get it wrong so much? Because they're humans. Yeah. They're not traders. They get excited, so to speak, by what's going on, whether it's markets going up, markets crashing. And there's a point where they're like, oh, we better report on this. This is headline breaking, news. And then, funny enough, it just so happens that at that point, the market is usually closer to a low.
Yeah,
or high.
It's the psychology is very interesting. You don't have to see much of a pullback on a major indices to then suddenly see a plethora of potential stock market crash articles coming out, because they're using that small move to use it as a way of baiting people into what might happen to get people to read the article. I always think of an interesting one where I remember watching the news. You can watch the news one day and the reporter's saying, the Dow is up by 2% due to, and they're giving a conclusion as to why. And then the next day, the Dow is down despite. So it's almost like they're just using the correlation of the news when it suits them, and then not using the correlation necessarily when it does. So I think as a trader, you've got to be very wary of getting sucked into, like you said, what reporters are reporting on rather than what they would specifically, what a trader would be trading.
And I think that you've got the day-to-day stuff like that, but it's the big headline stuff that we, as traders, we want to be looking out for. So when you see Reuters, Bloomberg Magazine, The Economist, FT even, when they start putting out headline features, that's when we want to take note, because it's the point when they put a headline feature out, they're reporting on what has happened. So they're getting excited by Dow's 50,000 or oil's gone to 100 or whatever the market is. And it's that they're already reporting on something that's happened in order to get them excited in order to write the article. So very often the move's already happened by the time they are writing said article. So as traders, we want to be using, as you said, that as a contrarian signal. And so when we do see front page Reuters, and I think you want to look at more than just it happening once. Don't get me wrong, that would garner my attention if I just saw headline Reuters, oh, Dow's hit 50,000, this is amazing, da da da. I would be thinking, oh, right, maybe we're getting close to a high, some form of near-term high. But it'd be even better if Bloomberg were writing about it as well. And, so, and that's the thing, we can use it as a contrarian signal, much like there was a great one in October of 2022. The dollar had just been going up for 18 months, and there was this article in Bloomberg Business Week front page. The dollar is like a wrecking ball, and the carnage is never going to end, sort of thing. And it pretty much within a week of that article coming out, the dollar had peaked and never went any higher. I say never. Well, yeah, it still hasn't gone any higher to this day in 2024. So that's a classic example of that. So certainly as traders, looking out from a sentiment perspective at what journalists do, and just consider they are just human beings who get excited by what's going on, and then they want to report by that.
I think you're making really, really good points. And I think the thing I pick up on is when you were talking about all of the different news articles is don't read one article and go, that person's saying this, oh, I'm going to be contrarian to that. It's when you see the collective making a point that a certain market is going to rally and could rally forever. It's the collective view of the journalists that you want to pay attention to, rather than cherry picking one just because it suits what you may want to do to trade and go, they're saying this market's going to go up forever, I'm going to short it. Well, it's just one person.
Well, yeah, and context is important as well. Fun enough, there was an article written back in March of this year, 2024, and the stock market had already been going up, but it wasn't. It still had legs in it from where it had broken out, and so sometimes, from a context perspective, the market might have only just be breaking out or about to break out, and a journalist could say, "Oh, Dow's going to go to." I keep talking about Dow going to 50,000. My example. So that would be a different context, as opposed to if the stock market had been going up and up and up for the last 6 months, and then an article like that came out. It's context is always important when trading, and when using information as well. Like, what's the context of this? Who is this guy? It's not who is this guy or girl that's written the article. It's the sentiment behind why they've written it. That, oh yeah, the stock market's been going up for ages. The stock market hasn't been going up for ages. It might be someone's just written an article saying, oh, the Dow could go,
Yeah.
That's different. So you're absolutely right. Context.
Brilliant. So we're moving on to something completely different to that, which is market jumping and strategy jumping. Whoa. I know this is almost an episode in itself, but yeah, I think this is something that, again, you could actually link it to what we've been talking about, which is the amount of information that's out there. So one of the things I think it's natural as a trader wants to do is to find the optimum strategy, find the best strategy, find the most effective risk to reward, combined with win-loss. They're looking for the best strategy out there. And the challenge is there's so much information that they can tap into through different sources, is they're constantly being told, truthfully or not, that this particular strategy has a 95% win rate, or this strategy has an 8, wins on 8 trades out of 10. So traders have been constantly subjected to different strategies, different ideas, things that they could be doing better. And I think sometimes with the best will in the world, a trader ends up changing, jumping strategies, adding markets in, yes, because of greed, but also just because they genuinely want to be in a position where they could be doing better. So I think it's something that traders have to be hugely aware of, because it's very easy to do, and it can come under the guise of just making a few subtle changes, and before you know it, you're trading in a completely different way than you were 6 months ago.
Yeah, and the grass is always greener. So all of a sudden there's something shiny and new over here. Oh, right, well, yeah, my strategy is... And I think when people strategy jump when they're... You're right, I hadn't really considered what you just said, that it could just be that they want more improvement. But I also think that a lot of people just as soon as their current approach is underperforming or they're flat, then they start looking around for the grass is always greener. And so they then become that strategy jumper.
And I've been there as a trader. When it's not working out, you start, that email that was always coming into your inbox, suddenly you pay more attention to because it's there. You think, oh, that looks good.
Yeah. I'm a bit flat at the moment, or I'm in a drawdown. Oh, okay. I'm going to try something else. And the problem with that is that trader's current method might be absolutely fine. It's just going for a flat period or a drawdown period. Every single strategy out there has drawdowns. But the problem is your average trader out there, as soon as they go into a drawdown, they're looking for something else. They're looking for the next holy grail. And they're discarding an approach or a strategy which might be perfectly fine. And then they go to the new one. The new one might work for a month or however long before it goes into its drawdown. And then they're jumping away from that one, and it just continues. And I've seen people doing that year after year after year, and they can go actually throughout their entire trading career, or let's say they're around for 10 years, and they never get it. They constantly are always moving because they always think that, oh well, this is underperforming now, I'm going to move on to something else. Sometimes it's just about having patience. It might well be that their strategy has completely underperformed. In fact, if someone is thinking about strategy jumping because their strategy's currently in drawdown, what advice would you give if someone's got a strategy which is currently in drawdown to say, okay, something else is going on here?
I think they've got to first put that drawdown into perspective. So they've got to assess the regularity of that drawdown. So is that something that happens annually, quarterly, depending on whether they're day traders or swing traders? So they've got to put it into context. So that means they need to have some previous data, be it the trades that they've placed themselves. So going back to previous trades, because it's easy to forget. It's easy to forget that 6 months ago, the same thing was happening now. Or if they're fairly new to that strategy, they've probably got to go and do some testing and see whether or not what they're experiencing right now is the norm. Because if it's the norm, that makes it easier to quantify it, and then it doesn't mean you won't strategy hop, but you've got some context to what's going on. So you can say, this is to be expected. Because I think if traders can see things and go, this is to be expected, or this is the norm, even if you don't like it, there's less chance of thinking, I need to go and change this or fix this. So that would be the first thing that I would do, is I would assess what they're going through right now, because traders fall for recency bias in the fact that what they're going through right now is the only time it's ever happened, or they want to be, if it's a drawdown, they want to get out of it as quickly as possible. So that would be my first. I think that would be the most important thing, is they need to put that drawdown into context to find out, whether or not it's
within its historical norms.
Yeah,
because it may well be, and in which case, you need to have a word with yourself, which is true. That's what we need to do constantly, is self-talk, to say, actually, there's nothing outside of the boundaries of what it's done historically. And so, but again, it's a reminder a lot of the time that we need that, or traders need that, to remind themselves that actually there's nothing, it's not outside of the historical stats. So I carry on with it. But so that's a bit on strategy jumping. We talked about, you mentioned,
market jumping, and that's, I think it falls in a similar guise, because why would you jump to another market if the market you're trading is okay? So it's a similar context. Is, again, if you've not got any data on whether or not that market is profitable, and what are the drawdowns on that market, you could jump to that market right at the point that market goes into a drawdown. Because psychologically, what would be your motivation to go from a market you're currently trading that isn't working to another market? Well, you've compared it to the one that you're currently trading. You'd look at that one and say, well, this one's winning. Yeah, I don't want to be trading. I want to be in a market that's doing well. But the reality of that situation is, you could be drawn to that market because it's going well. You've got the contrast that you're trading a market where you're in a drawdown. You jump to the other market just at the point that market goes into a drawdown. So then you're in a situation where you've got multiple drawdowns, and you've ended up with more losses than you would have done if you just stuck with the market you originally thought about.
Exactly. I don't think I had much more to add on that, because that's where I was going to go. Yeah. But it's true. And I think it comes back down to that that short-term mindset towards instant gratification, rather than saying, well, look, I trust this market or markets that I do trade. They may have gone a bit flat or a bit range-bound. And if you're a trend-based trader, you don't know that a market's in a range until it's in the thick of that range. You don't know when you're getting some of your setups that, oh, okay, it's about to come back and it's just going to stay in a range. So the problem is, much like strategy hopping, because of that short-term mindset to instant gratification, I need to be making money, now, this month, today, this week. I'm going to have to go off and look elsewhere, like you said. And yet, if people can have a bigger picture view of everything, so delayed gratification, then they're not going to be too concerned about what that market's doing right now, because they've traded that market or they've tested that market, and they know that, okay, in the long run, that will do whatever it needs to do. It will wake up, like you said. Otherwise, you jump to something else, and just as that one's about to go and, stitch you up, so to speak, and then it's compounding. Well, really, when you could have just sat back, you might not be having, if you're systematic trading, a lot of signals, for example. So you're getting bored. So you want to market jump then as well. You're just bored. It might not even be you're in drawdown, and it's just not enough. So, but markets go from low volatility to high volatility back to low volatility, and so these things change. We were only talking about this on one of the last shows, talking about summer period. Yeah. That, people say, oh, it's summer, I'm going to take the summer off. Might be boring. Well, it might be, but it might not be. And in fact, this very summer, there's actually a bit going on. There are patches where it goes quiet, and then all of a sudden, boom, we're seeing markets moving. So you just don't know. And so just when you think that your markets you trade are boring or whatever, they might be about to break out. You put your view, your eye gets deviated to something else, which looks attractive, and then when you're focused over there, your old stuff all fires off and you've missed it, and then you're frustrated. Frustration leads to the dark side. And so all of this stuff feeds into mindset always. It ultimately comes back to mindset, because then you end up frustrated because, why didn't I do that? And then you berate yourself for it. So, yeah, strategy jumping, market jumping, people need to have some serious considerations before they do it. It's not that you can't, but you have to make sure you're doing it for the right reasons.
I think that's a perfect way to end.
And on that note, his name's Ali Crooks.
His name's Charlie Burton.
Trade safely out there.